Hello everybody, I hope you enjoyed our new introduction video and welcome to this one where we'll be running over some of the REITs as you saw. First we will go in and take a look at how these stocks have been performing and whether they're in what we consider an uptrend or a downtrend. And as we can see here across the board, year to date, all of them has obviously been hit hard by the coronavirus, so all the way up to 55%, some of them a bit less. O here with minus 14.10 only. If we then move into the income part, we're obviously interested in understanding whether these companies are earning any money. So if we take a look at the net income, we can see that O, SPG, FRT, REG are earning money, while as SKT has lost some money. If we can also take a look at the net profit margin average for the last 4 quarters, benchmarked against the industry, O, SPG and FRT are all doing really well here in around the 30%, while as REG and especially SKT is doing very poorly with only 8.36 and minus 12.64, so really not good numbers there. We can also take a look at the BNHM score, which is a mathematical model that determines whether a company has manipulated its profit, and we want this to be less than minus 2.22. And what we can see here, all the companies that we have data from, with the exceptions of REG, is actually a small red flags. We can also take a look at the Sloan ratio, which identifies if a substantial part of the earnings are non-cash accruals. We are not interested in that, of course. And we want this number to be between minus 10% to 10%. And we can see that O is 11.11, so it's acceptable, but a little bit more red flag than some of the others here, which are all in the safe zone. So if we quickly go into the ranking overview, we first looked at the stock and the trends, and what we saw was that O and SPG was in an uptrend, FRE and REG and STK were all going sideways. On the net income part, all of them were positive with the exception of SKT. On the net profit margin average for the last 4 quarters, SPG was the best, followed by O, FRE, REG and SKT in the end. We then want to check the return metrics and understand how high returns on cash flow margins is being generated by these companies. So if we first take a look at the return on invested capital benchmarked against the industry, we can see that SPG are the only one who's outperforming the market, while as SKT is doing really poorly here with minus 0.66. On the levered free cash flow margin, O doing really poor with minus 83.16, while as SPG with 36.30 and SKT 23.71 are doing really well. We then move into the balance sheet ratios and want to understand how strong the financial position are of these companies. So if we first take a look at the current ratio and cash ratio, we can see it looking quite well across the board, especially FRT and SKT. The total assets versus total liabilities, in general, want that to be above 1.5. Here, O and REG are doing really well, while as the others have some small warning flags. On the debt equity ratio, O again doing really fine, but FRT is the best with 1.82. We have a red flag here with SPG on 11.68. However, due to the current ratio and cash ratio where they have a lot of liquidity, and because they're part of a larger group, and because they're looking at acquisitions, I'm a bit more comfortable with still seeing this number. However, in general, I would stay away from companies that have such a high debt equity ratio. The same as well with SKT, it's also looking not so good with 6.23. Then we can look at the Altman set score, which is a credit strength test that assesses the likelihood of bankruptcy. Want that to be above 1.8, but none of the companies are living up to that as of today. The Piotrowski score assesses also the company's financial position and how strong it is. Want that to be equivalent or above 5, and we can see everybody with the exception of SKT is living up to this. So back to the overall ranking, we looked first at the return on invested capital, and what we saw was that SPG followed by FRE and O were doing the best on the levered free cash flow margin. SPG again doing the best, followed by SKT and REG. On the balance sheet and the title ratio, O was doing the best together with REG, followed by FRE, and on the debt equity, FRE followed by O were doing the best. We had some red flags for SPG and SKT. However, specifically for SPG, for the reasons that I mentioned, I am not too concerned about them for those numbers. Next, we want to take a look at the shareholder yield and how much value is returned to shareholders through specifically dividends for the REITs, because 90% of their taxable income needs to be distributed to shareholders. So that means that these companies tend to pay better dividends than the market. And as we can see across the board, really nice dividends. The lowest is O with 4.37 and the highest is SKT with a whooping 21.7%. Really attractive. However, to the history with SKT, the share price has plummeted for the last 5 years, so I would be a bit concerned as to whether this is sustainable going forward. However, it may, for some of the more risk appetite, be very attractive, this dividend. The buyback yield for these are not as attractive because they pay so much out to the shareholders in the dividends. When they need to fund their or grow their operations, they need to raise equity, and how that is often done is to issue shares, and that's why you will see some of the companies here have negative. So I've left that out purposely for this video. That is also on the payout ratio. I've only looked at the proportion of earnings paid to shareholders in the form of dividend, and as we can see, it's looking really fine across the board, especially SPG with only 43.19%. Next, we want to understand the earnings per share and growth, and we basically want to understand whether these companies are expected to grow in the future. So if we took a look at the EPS growth forecast for the next 5 years, we can see benchmark against the industry that all these companies are actually expecting to have considerable growth. So that is really good. The best REG with 9.10%, while as O is doing the worst with only 5.45%. Usually I would look at the revenue growth for the last 5 years. However, for REIT specifically, there's a much more important metric for me, and that is the FFO that you will see down here. And basically that is funds from operations, and it's a metric that basically tells how well these companies are managed. It's an earnings metric, and it's really useful when you're benchmarking REITs against each other. Again, the reason that I've only taken for the last 3 months is because this was the worst quarter due to the coronavirus, so I thought it would be interesting to look at how well these companies have delivered on this based on the situation that is maybe the worst ever, with a lot of closure of stores for a long period of time. And what we can see is that SPG is outcompeting the others by far with 2.96%, so really good number. FRT also posting a respectable 1.88%, while as O is again doing the worst here with 1.35%. So back to the ranking overview, we first looked at the shareholder yield and more specifically the dividend yield, which is really important for REITs. And what we could see was that SKT was doing the best by far, followed by SPG, REG, FRE and O. Then we went into the EPS growth forecast for the next 5 years, and we could see that the expected was that REG is expected to do the best, followed by SPG, and FRE and SKT had the same 6.70%. On the funds from operations ratio, SPG was doing far better than the rest, followed by FRE and REG. Next, we want to understand whether these companies are currently under or overvalued, and one way is to look at the projected earnings growth ratio, and based on Peter Lynch fair value, we want this number to be below 1, because then it means that they're undervalued. If they're above 1, they're considered overvalued, and all of them we can see here, with the exception of SKT, are overvalued. SKT we cannot assess because they have a negative PE. If we look at the 4 ones here, we can see that SPG is the one that is coming close to being undervalued with 1.40. Next, we can look at my fair value intrinsic estimated, which is basically based on a lot of assumptions and numbers. And if we look at O, they are slightly overvalued with 1.74%. SPG, pretty decent upside on 7.62%. FRT, fairly valued. And REG and SKT are both overvalued from my angle. The beta ratio just shows the risk volatility in relation to the overall market. And as we can see, SPG and SKT are more volatile than the market. The rest is less. We can also look at the book value per share, and basically if it's above 1, it means that they are undervalued, and we can see here again all of them are overvalued. However, both REG and SKT are coming respectively close to the 1 mark, which would mean that they would be considered undervalued. We can also look at the relative strength index for the last 14 days. We want that to be below 30 because that means that they're oversold. We don't want it to be above 70 because that means that they're overbought. We can see all of them are fairly close in the middle range, so no clear indication as to whether there will come a pullback or an upside opportunity. Finally, we can also look at the analyst recommendation. Again, I don't follow them blindly because they have their own agenda, but I always think it's good to try to stay on the same side if possible. So if we look at the consensus price target, which is kind of like the middle ground, we can see that for O, there's an upside on 10.14%, whooping 34.65% upside on SPG, 20.94% upside for FRT, 25.70 upside on R.E.I.T, and a downside on 5.31 on SKT. So back in the ranking overview and looking at the overall value assessment of these companies, I believe that O is fairly valued, SPG undervalued as the only company, FRE and R.E.I.T are both fairly valued, and SKT is overvalued. But I would say none of them look particularly interesting. So again, none of these companies look extremely attractive, but if we should select the best among the bunch, we would, based on the highest net profit margin of 32.24%, the highest free cash flow margin of 36.30%. It's part of a larger group that is looking at acquisitions as we speak. It has the highest FFO for the past 3 months and is the only undervalued company among the group according to us. We believe that the top pick is SPG Simon Property Group. If we were to select another company, that will be FRE. However, we would like to stress that none of them are very, very attractive investment opportunities, but if we select one of the two, it would be one of them. Please note that this presentation is only for entertainment purposes. We are not professional advisors. We do not work full-time with financial investment. So this is just purely entertainment purposes, and we would urge everyone to do their own due diligence as well. Go deeper into these companies before taking an active investment decision. We would do that as the next step with these companies. Before we buy anything, we will investigate them further. We hope you enjoyed this video. Please stay tuned for more content. Please comment, like, and subscribe. Provide us any feedback you will want that can improve the videos. And otherwise, have a very nice day.